Hi everybody and welcome to Forex.com's Q4 outlook for Forex space. So this is a brief outlook of what our Q4 expectations are that could impact you and your trading for this year. So our first main theme is that we believe tapering is going to be put to bed for 2013. We think there's now a very low chance of tapering, definitely not in October, but they may even delay it until 2014. Now that has real material implications, but the main reasons for the delay is obviously the fiscal issues that are ongoing in the US, with no end in sight to the brinkmanship between Republicans and Democrats, with a delay in economic data and with the threat of the US even going into a default, then we really see the Fed keeping to its path of quantitative easing, putting tapering to bed for another few months. Basically, for as long as the US economy, for as long as there isn't economic data because of the US government shutdown, for as long as there is a threat of a default, the Fed is not going to want to take its foot off of the printing press right now. Added to that, we obviously have the prospect of a new Fed governor next year. Now, we think if we are to get a new Fed governor, for example, maybe Janet Yellen, she's the vice chair of the Federal Reserve, she is the front runner now. If she is to be introduced, we think she may not decide to taper in early 2014, say in January, but she may push that out to later in the first quarter. However, if fiscal issues in the US really do boil over, then what we may see is Ben Bernanke come back on board just to keep things stable. So he may be elected for another year, for example. In that environment, then we could get tapering closer in the first quarter of 2014. But overall, what does this mean for the US dollar and also for US rate expectations? Well, here is the latest Federal Reserve interest rate expectations. As you can see, the bulk of Federal Reserve members expect interest rates to be at 1% in 2015, 2% in 2016. Well, for as long as QE remains on the cards, as long as the fiscal crisis in the US still continues to cloud the economic outlook, we think that we could see this being pushed out further, particularly in December, whereby interest rate expectations may be pushed out even further, and we could see rates at zero for longer. So that's one of our key things to look at for this quarter. Number one, the end to tapering, and number two, interest rate expectations being pushed out to further for hikes to come in later than expected, so not in 2015 as the bulk of Federal Reserve members expected in September. Now, the second thing that we looked at is forward guidance. It's been a very hard sell for the Bank of England. However, for the ECB, it's actually been better, or it had been more effective, I should say. Now, there was a St. Louis Federal Reserve report on forward guidance, and believe it or not, the Fed itself thinks that forward guidance has not got fantastic history of results. The empirical data suggests that it's not that effective. When it is effective is if you don't have economic thresholds, or if you do, if you're very firm, and you tend to stick to keeping your forward guidance even when interest rates should probably be raised. That's when it has the biggest impact. So a lot of questions about forward guidance there, but the good key thing for the ECB at the moment is that they don't have any economic thresholds, so they're not being challenged. So as you can see here, even though obviously US yields are at a higher rate than German ones, even though German yields have been moving up, we're using Germany as a benchmark here for the Eurozone, and that's largely a result of better economic data out of the Eurozone. But overall, yields have remained more subdued in Europe than elsewhere, which suggests that the ECB is doing a better job of its forward guidance than the UK, for example, and even the US. So potentially we could continue to see German yields lag their counterparts, particularly if we see any pockets of weakness in the European peripheral recovery. Now, the last thing we're going to concentrate on today is the overall global economic outlook. We see it stabilizing. Obviously, the caveat to that is if the US does default, in which case that could cause absolute panic in the market. But let's take Washington at its word that it won't let that happen. And then we think we're going to see China stabilize. We think we'll continue to see the Eurozone stabilize. We think the US could certainly pick up, especially if we get over these fiscal issues. And in the UK, we think data will moderate, but it will still remain at a fairly strong level. Likewise, Japan, we could see a good boost to GDP in the fourth quarter, largely because of that sales tax in April of 2014. That could potentially bring consumer spending forward. Now, what does that potentially mean? As you can see here, a growth in the Eurozone. This is the Eurozone Composite PMI. The latest one for September is included. and really it's back at its highest level since mid-June. So that should certainly support the Eurozone, and it does, and support the Euro as well. So it does suggest that this recovery, particularly some very good data out of France and Italy recently, does suggest that it's more broad-based. So overall, developed market growth is looking pretty good. Emerging markets are stabilizing. We could also see emerging markets get a boost from that currency weakness earlier in this year, a boost to exports there. That should be good news for stock markets, even though it does also open the door to some prospect of a discussion about when the Fed will taper towards the end of this quarter, obviously all being well with the fiscal issues in the US. So that's just a taste of our Q4 outlook. Please see the rest of it on our website on forex.com, and please do join us again for more. Thank you.